Hi, my name is Sandate. I'm a partner with Cygnus Capital Real Estate Advisors. We are an alternative asset manager headquartered in Atlanta, Georgia. And today I'd like to take a couple minutes and tell you a little bit about what we do and more broadly and more importantly, the opportunity in what we call special situations real estate investments, which we define as opportunities involving workouts of non-performing loans, distressed loan portfolios, defaulted commercial mortgages, and other debt securities that are collateralized by commercial real estate. Our firm, Cygnus Capital, has been in existence since 2010, and we got started after the last financial crisis, and over the last 8 years have deployed capital into what we define as opportunistic special situations and distressed real estate through 4 primary programs. But today I'd like to focus on more specifically some of the most common myths or misconceptions about investments in this particular area. We've spent a lot of time over the last 8 or 9 years talking with a variety of different investors in commercial real estate, from institutions, intermediaries, family offices, and also high net worth individuals. And I would say that the 3 or 4 common myths or common misconceptions about our particular space are, I think, important to talk about and important to reiterate. And so what I'd like to do is take just a couple of minutes and tell you about those common questions, and hopefully they'll be relevant as you evaluate your real estate portfolios in light of very recent volatility in the capital markets. And also as we look at the end of 2018 and going into 2019, a lot of the conversations that we're having with our LPs and with prospective investors really center around kind of what to do and how they're thinking about positioning for what some view as a potential pending downturn or some type of a correction in the market. We've had a pretty good run in commercial real estate over the last 8 or 10 years. And so I think a lot of investors are starting to think about ways to get quote unquote defensive or to take a little bit less risk while remaining invested in the asset class. And so what I'd like to talk about are some of the common myths or misconceptions about distressed and special situations real estate. So first and foremost, I think the biggest question or the biggest misconception we get about our space is, what distress is there? And I think that stems a lot from the fact that a lot of asset classes have done quite well over the last 8 or 10 years. And if you look at sort of the major food groups of real estate, whether it be hospitality, office, industrial, multifamily, a lot of those have done quite well. While cap rates have come in here over the last several years, a lot of people just don't see, a lot of investors in particular just don't see distress. And so one of the things that we often tell people is that the commercial mortgage market, if you include multifamily, is over a $4 trillion marketplace. And we say that around our office, that bad loans are made every day. They may not materialize for 3, 5, 8, or maybe as long as 10 years. And so loans that were made in the last cycle in 2005, 6, and 7 are still being dealt with even today. And so when you start with a $4 trillion market, and then you think about the fact that the CMBS markets went away and they've come back, there's a significant amount of debt that's issued literally every day, and some of it is securitized and some of it is not. And so when you think about non-performing loans and workouts, there's always something to be doing, particularly as you move down into the lower end of the market, particularly when you get down below the top 50 MSAs and you look at loans with an unpaid principal balance in the tens of millions versus in the hundreds of millions. So I think the biggest question is around what distress, and we often point folks to the fact that, yes, while Federal Reserve data shows that the non-performing loan space is less than 1% defaults today, and it peaked at over 8.5% after the last crisis, 1% on a $2.5 trillion market or $4 trillion market is still significant. And so that's the first common misconception about opportunities. There's plenty to always be looking at and doing. in terms of this space. So the second misconception about the special situations or distressed is that there is some sourcing advantage or some unique skill set around, or some advantage in terms of being able to find and identify distressed loans. And what we tell people is, there's different types of workout firms. There are firms who specialize in the loan workout and the legal workout, and then there are firms who focus in both of the legal workout and also the what is called bricks and mortar, or the actual real estate workout. And as a firm, we focus in both areas because we think that you can't do one without the other. And so, one of the things that we focus on is really looking at a broad spectrum of transactions across a variety of property types and geographies. And because of that, we see transactions literally across the country, and sometimes in far-flung secondary and even tertiary locations. And our focus and what we try to educate investors around is there are opportunities to make nice double-digit risk-adjusted returns without leverage by being willing to look at pools, at real estate that's not in maybe a 24-hour city, that's below the radar of maybe a large institutional real estate owner or private equity firm, who simply because of their size are not able to, for structural inefficiency reasons, look at transactions below, say, 20 million. So we often get the question of how do you source deals, or how do you identify opportunities? And while this, video message is not so much about Cygnus, I think it's important for people to realize that there's real estate literally everywhere around the country, in hundreds of markets. And while it is a local business, there's plenty of assets that go bad for various reasons, or loans, more importantly, that go bad. I think the third question or misconception about investing in this particular area is that you have to have, a lot of attorneys or a big staff of bankruptcy experts in order to execute this and make returns in non-performing loans. I think that what we try to help people understand is if you're thinking about investing in distressed and non-performing loans and workouts, is I think you want to be able to identify managers or strategists who have the requisite credit skills and loan workout skills, but also have the ability to take the assets through a workout, a bricks and mortar workout if necessary. And so I think that as investors, and you're thinking about maybe looking at this particular space, particularly given views around there might be a correction coming, or there might be a little frothiness in the market, it's important to find managers or investment firms who have not only the expertise, but the background and the track record, and then also the in-house skills of doing not only the legal workouts, but also being able to take possession, as we say, of the physical real estate, and then take it through a natural workout, and generally being able to do that as much internally as possible versus having to leverage, a JV partner or some large institutional firm who's backed you in acquiring a deal. And then I'd say fourth, and finally, the final question that often comes up from investors as we're talking about opportunities in distress and in special situations real estate is what is the best way in which to make an investment, or the best way in which to access the asset class. And I think that you have to spend a little bit of time looking at the various ways in which you can enter this particular piece of the market. All managers, obviously within real estate, have different vehicles and different legal wrappers and structures. And so I think that you have to try to match the asset class and the amount of time that it's going to take the portfolios through workout and take the portfolios through their natural conclusion with the manager's underlying investment program and their underlying investment product and strategy. And so we spend a lot of time talking with investors and prospective investors around, what their portfolio currently looks like, and whether or not an allocation to distress or special situations is in any way going to diversify the portfolio, which hopefully is the idea, is to further diversify the portfolio, Is it going to add additional correlation to other holdings that they have in the portfolio, particularly within the real estate portfolio? And then I think finally, is the opportunity set significant enough? Is it big enough where it's meaningful to the portfolio? And so as we talk with a lot of investors across a variety of different channels, we try to really dig in to what the investor currently is holding and what kind of exposures they have, and then talk to them about what is likely to materialize, whether in our portfolio or potentially any other managers that they're considering. Because every commercial real estate investment firm or private equity real estate firm has obviously different approaches. So those are some of the common questions that come up from investors. We certainly, believe that this is there's a really compelling opportunity, regardless of what's going on in the macro environment or the commercial real estate market. We think there's always opportunities to be doing workouts and to be taking advantage, frankly, of the mistakes of other folks, whether they be lenders or borrowers. But you need to really think about identifying a manager or a team or teams who have the ability to not only take the loans through a workout process, but also, if necessary, and in many cases, very likely, take the real estate and be in a position to do something with it. Thank you.